So now we will begin the presentation, and I would like for us to focus on the first couple of things that we will discuss. The first one is 3 levels of retirement expenses that we will uncover. Now, the 375 strategy is referring to 3 levels of expenses. We will break them down depending on importance and discretionary versus non-discretionary, which is important to differentiate, and the 7 sources of income in retirement and 5 options of making income cover expenses. So we'll go through 375 strategy and also see if there is anything else we can add to it based on your interest. So please feel free to put your thinking hat on. Maybe there is something you are here because you have a very pressing question you would like to know. So I'm very happy to answer those for you. I've done retirement planning for over 18 years, and it's been many different scenarios presented to me, and I've been able to find some answers, majority of which lead to a more unconstrained, more peaceful retirement. Reporting retirement questions. So will I have enough money to retire when I want to retire? Everybody asks themselves that, and either they try to figure out that number themselves or they ask a professional. It all depends on your longevity, on your income needs, on your expenses, of your lifestyle, a lot of things to consider. Will I run out of income in retirement? That's something that we all need to find out at least 5 years before we retire. We can't ask that question right in the midst of retirement. So we need to get the answer, and probably with high probability of success. We can't just say, oh, maybe. It has to be over 80% success rate given all kinds of inflation and the market returns probabilities. So that's something I would like to focus for my clients when I run their probability of success in retirement. How will inflation affect my retirement income? Inflation right now is on everybody's mind. We know inflation does eat into retirees' income, and it's very important consideration because if we're not keeping up with inflation, we're reducing our lifestyle over time, right? So give you an example. If inflation is 3%, over time, it takes 20 years for your expenses to double. In reality, it's about 21, 22 years. So if you are not keeping up with inflation, it means your lifestyle eventually will go down. Not immediately, it will take 20 years, but because a lot of retirees right now spend over 30 years in retirement because of life expectancy, we do want to make sure that your income is keeping up with inflation. And we'll talk about the ways to do it. Retirement readiness or not. You probably want to look into a formal retirement strategy either created by yourself if you have time and desire to work on it, or with the help of professional, your financial planner, your CFP, your financial advisor. Assuming there is a limited options for improving financial situations, what are your choices? What is your best defense against failure? So you would need to find yourself at least few strategies that will improve your retirement picture, especially if you come into this retirement preparedness very close to retirement date. So ideally, you start retirement planning 15, 20 years ahead. If you are 10 years away, that's already a pretty short period of time to get things ready. But if you have enough savings, potentially you can prepare yourself for retirement as long as you saved enough money about 5 years prior to retirement date. If you're very confused about complexity of financial plan or how it's going to work for you, this presentation will help you a little bit, and you need to dig further to see if there is anything else you need to know before you retire. Think retirement is simply the reverse of accumulation stage. So if we spend about 30 years plus accumulating our assets, let's give an example. You start working soon after you graduated from college, 25 plus 30 years. So by 55, 60, you're probably getting closer to retirement date, right? So now from accumulation, we're going to distribution phase. And distribution phase is not an easy phase because you're switching from saving money to spending money. And guess what? It's very difficult for a lot of people to change their mindset going from accumulating, saving, investing, raising kids, paying mortgage, to suddenly I don't need to do any of that. Instead, I need to spend down the money. There could be a fear factor. How much can I really spend before I run out of money? So we need to have a balancing act in retirement between income, expenses, and your assets to make sure that everything comes together. So let's talk about a few things on our agenda. So we'll talk about difference between accumulation and income, 375 strategy I mentioned, and what would be the next step you personally can take. Okay, so accumulation stages. So retirement accumulation stage is the first column, and that would be first objective, how much would be enough for me to retire. Number one, I will give you a very, very rough idea. So if we talk about safe distribution rate, and we refer to most recent studies, we know that if you take between 4 and 6% from your portfolio, and you can have a flexibility between how much you take based on rate of return, that would be your additional income to a guaranteed income stream, like Social Security, pension benefits, rental income. So now you can ask yourself, besides those guaranteed income streams or fixed income streams, how much do I need in portfolio not to run out of money and distribute myself at between 4 and 6%? So that would be your number. And that will also based on, is there any other expenses that you have not anticipated, right? Medical expenses, maybe helping kids, helping elderly parents. So all of it needs to be considered in your budget. Asset allocation. Asset allocation and accumulation stage looks very different than in retirement stage. Accumulation stage asset allocation generally has preference for stocks and less investment in bonds. However, in retirement stage, it can reverse or can stay the same. It also depends. Old rules that you need to keep as much in stock as is your, and as much in bonds as you age. So this old rule means that if I'm 65, then I need to keep 65% of my money in bonds. If that would be a good rule of thumb, you would make no money in the last 5 years till we had the higher interest rates, and finally money market accounts start paying interest. So we need to consider not only your age, your accumulation amount, your needs for income, and also your risk tolerance. Only then we can determine what's the perfect asset allocation. Currently in the accumulation phase, and then later on in retirement. Should they look different? Absolutely. And how they're going to look different, we'll examine during this presentation. Time horizon. Time horizon to retirement usually are very known. It's probably between now and when you reach age of 65, 67. Some people want to retire sooner, 60. So it could be a very known goal for you, at what age you would like to call it a day. It's completely different when we talk about distribution stage. So accumulation is how much I need to save, how much money I'm making, how much taxes I'm paying, what are my extras, can I save more, can I pay less tax, and what else need to be considered for my heirs, for my children. So very much driven about how much I'm getting, how much I'm spending, and how much I'm having. In retirement income stage, we are looking at absolutely different objectives. Objectives goes into not to outlive their assets, right? The biggest fear for most retired women is not to be a bag lady. And that comes in hand with not outliving your assets. Asset allocation, withdrawal allocation looks quite different from accumulation allocation. It should be ideally a little bit more conservative. It should be focused more on dividends. The distribution rate should be equal or lesser of how much you potentially will be making in your portfolio on a long term. And the time horizon is very unknown, even though we know average life expectancy for female is a little bit longer than male, and we're talking about probably between 19 and 92. But it's still not a known date. So we need to plan a little bit above your life expectancy just to make sure that you have some extra money for unexpected. The largest expense that retiree will have, it will be paying for medical costs, for increased cost of drugs, increased medical expenses to take care of you, and also for some sort of long-term care expenses. So these need to be considered very seriously because they can be a huge percentage of your overall assets. And that's number one default rate for most retirees, number one deficiencies that we see for retirees when they didn't plan for a large medical expense. So now let's examine strategy 375. 3 would be our level of retirement expenses, and number 1 is going to be for survival expenses to cover your most basic needs. Food, shelter, medical expenses, PG&E bills, something that if you don't pay, you cannot maintain, right? You cannot be a renter, you cannot be a landlord, you cannot be a homeowner. So survival expenses is your basic bare minimum. You probably can ask yourself, how much would that be on average? In Bay Area, I see this number could be anywhere between $3,000 and $6,000, depending how big your mortgage, how big your property tax. So, but somewhere between 4 and 5 is a very typical number. Lifestyle extras. Those are desired, we call them discretionary expenses. This could be your gifting to children. It could be also your extras for vacations, for any hobbies, for golfing, for any healthcare, exercise, and etc. So that lifestyle extras could be any number that would be palatable to you. However, financial planner's job is to bring you a number under this desired lifestyle extras that is reasonable, so you are not overspending your assets. But we always start with the baseline, how much would you like to spend? And then we'll give you an idea how much you can truly afford to spend on your discretionary expenses. And the last one, which a lot of people are concerned and would like to have, is funds remaining for your beneficiaries. A lot of times when I ask my clients, how much would you like to leave for your beneficiaries? Most of the time, I don't get a concrete answer, X amount of dollars or this and that. Sometimes I get an idea, I'm going to spend all my liquid money, but I want to leave the house for my kids. Or you can say whatever left out is going to go to kids. So not a lot of concrete planning, but basically idea that I would like to leave something for them. So if you do, we will have a discussion which asset would be preferably to leave. And when we'll talk about the distribution strategy, I'll show you which assets usually considered the best to leave for your heirs, if there is anything to leave. Most importantly, you need to take care of yourself first. And if you're taking care of yourself, then you, at the same time, just took care of your heirs so that you need to worry about supporting you in retirement. So number one goal is to put a mask on yourself first when you're flying in an airplane, the oxygen mask, and then you put it on the ones around you, right? So you can support yourself first, then can help those who might be dependent on you. Same thing here. We need to make sure we are not a burden for our kids, for our heirs. We take care of ourselves, and whatever extra left, more is better, less is still okay. Now, 7 sources of retirement income. Number 1 is Social Security. You probably have seen the statistics is usually how much Social Security income is represented as a part of your overall expenses in retirement. The number varies between 30 to 35%. So it makes us understand that about 1/3 of your expenses will be covered by Social Security income. So what about the rest? Qualified ERISA plans. That would be your 401k, 403b, pension plan 457, anything else that comes out of your pre-tax dollars. Traditional IRAs. Those are your own retirement plans, not employer-sponsored. Most people, once they retire, they roll their qualified ERISA plans into a traditional IRA, keep it under their own name and under their own traditional pre-tax accounts. The Roth IRA, not a very big accounts in general because of limitations how much you can put away on based on your income, but it's a wonderful and valuable account to consider, and you should take any advantages of any low income years to consider some IRA to Roth conversion to shelter any earnings in these accounts from taxation, because anything you earn in a Roth account is not taxable. So I see a lot of under-planning around Roth IRAs, and Roth IRA is fantastic, a planning tool because it allows you to take money in retirement tax-free. Non-qualified assets means assets that you already pay tax on, mutual funds, CDs, stocks, bonds, you name it. Everything liquid, but it's not in retirement assets will be considered non-qualified. The only tax liability you have on those assets is your earnings, your dividends, and also capital gains. Continued employment. A lot of times I see that retirement has been redefined. For people who are retiring in their early 60s, they're not completely quitting jobs. They're going back into consulting. They're working small jobs like Whole Foods or flower shops. They continue monetizing their hobbies. They're painting, they're selling their painting. They're doing all kinds of fun stuff that potentially can bring them a little bit of money. They're doing consulting, especially in Bay Area. A lot of engineers continue doing consulting here and there, and then eventually they retire. So it is because we are spending more time in retirement. People might retire at the same age, but they might not stop working completely for a couple more years. And it's a great way to transition. You go into a much more relaxed atmosphere of working for yourself. You have some tax deductions going for yourself, and you have a little bit of income and welfare. That's not a desirable way of income. It's basically by being supported by the government, and it's very limited, and you have no choices or options there. Let's think about hypothetical scenarios here. Let's examine Ken and Patty at retirement, and we will be using a Reengineering Retirement Strategic Workbook. For that example, I do have a copy. If you like to have a workbook copy so you can work through your own retirement, you can definitely request that. We can send you a copy. Both of them are 66. Combined Social Security benefits $2,000 a month, defined benefit pension income $500 a month, home mortgage paid off, free and clear, IRA, a rollover $500,000, savings portfolio $400, and we have estimated retirement expenses, survival expenses, must spend $36 and desire $20,000. So these folks are not living in Bay Area, obviously, because the expense is not as high, so they're $56,000, but they're there. Right now, probably average retiree would spend in nationwide $60,000 a year, and in Bay Area between 70 plus. If you're spending less than 70,000, you're doing very well. They do have desire to leave a legacy, so we will see if it's possible. So now what we'll do is we will match retirement income with expenses. So first, Social Security, $24,000. That will go into surviving benefits, right? So you can see surviving benefits going into from Social Security to your survival expenses. So that's covering qualified ERISA distribution. So Patty pension benefits $500 a month equals to $6,000. These two distributions are pretty much guaranteed. If you ask me, so we're going to run out of Social Security benefits, the answer is no. Most likely the benefits will have a different structure. Most people who are retiring now will get the benefits of age of 66, 67 at full payouts. But if you are in your 40s or even 30s, most likely your full retirement benefits will not begin till you're 68, 70. That's how they will address it. They might not put a lot of inflation adjustments on those benefits in the future. They will try to control it. But Social Security is there for us and probably those who are coming after us for the next 20 years. So you can see that 24 plus 6 to $30,000 already are met by their guaranteed income stream. That means that no matter what happens, your basic expenses are covered. Next, we're looking at non-qualified assets. So they have $400,000 and $280,000. So if we have a 5% rate of return, which fairly low return with a fairly conservative portfolio, you can distribute yourself for the next 25 years, 5%. So if they put money in an annuity, or they don't have, but let's say it's a guaranteed distribution rate at 5%, they can also fund their needs, which is exactly what they need. They need $36,000, $6,000 guaranteed for the rest of their life. That's the beauty of certain annuities, though you can create your own annuity. Why? Because if we can put money in the bank at 5% rate or in a bond portfolio at 5% return with very low volatility, you can continue giving yourself distributions of that 5% without a lot of risk. So it's self-created an income stream from non-qualified assets. The next one would be, excuse me, I'm moving forward. Okay, so the next one is desired expenses. So if you continue working for a couple of years until 70, you will have a little bit of income coming that way. But if you don't, then you need to start taking money from your IRA. So IRA distribution voluntarily before your required distribution date. When is your required minimum distribution starting? They've been pushed out now to 73, and the rule says that you can take it out by April 1st, the year following you reaching the age of 73. So you can start taking RMDs. Minimum distribution should last your lifetime. That's the whole idea and the goal of it. If you're taking more than RMDs, as long as you're making more than what you're taking, your retirement account will continue to grow and live beyond your life expectancy. So now they've been able to fund $18,250 from their RMD distributions. If you remember the scenario, their desired expenses were $20,000, so they're right there. And now, next one is Roth distributions. So the Roth distributions can be also funding your desired, or even better, if we redirect Roth to create a legacy. So why Roth accounts is such a great account to pass on to kids? Simply because of the rules that we're working with. Right now, the rules have changed. About 2 years ago, the IRA distributions, if they inherited by not spouses and by not exempt group, like a disabled family member or someone else, then had to be distributed to the beneficiaries within 10 years of inheriting it. So you can take a lump sum, you can stretch it over 10 years, you can take it by the end of year 10, but they must be distributed. It's quite different from what was before. Before was that you can stretch it as a beneficiary over your lifetime. So because of that, a lot of beneficiaries will be hit with a huge tax bill, because if you're giving your child an inherited IRA at the end of your life of $1 million, they will have to distribute, and they probably in their 50s and 60s, in their top earning years, they probably will pay a lot of tax on an IRA distribution. That's not very desirable by either family. But if you give them, so if you're spending IRA account and paying taxes as you go, that might be a better distribution strategy than spending down money from Roth. And then the Roth account, whatever left or whatever is not untouched through your retirement years, can go as a legacy to your heirs. Even though they still need to take money within 10 years, there is no tax to pay. So this money can grow for 10 years, double in 10 years, if you have market-like returns, and then be passed on to your beneficiaries with zero tax liability. Fantastic accounts. Unless the law changes, the distribution to your heirs has changed quite a bit. We used to suggest people to pass on the retirement assets because kids can stretch that distribution for their lifetime. We're pushing out all the tax liability forward 30 years, great. Now law has changed. The IRS want to tax you at latest year 10. And that's the case, then it might be a very huge deal for those who inheriting those assets. So that's one of the ways for us to bottle the income tax. Now, 5 options to improve your income. Well, let's talk about a couple of those that potentially can be beneficial. First is re-examine your expenses between discretionary and non-discretionary. Always make sure to allocate enough expenses toward your healthcare. Health savings accounts, if you're working, one of the great options. If you have an HSA account and you don't spend the money, eventually it becomes like an IRA, and later on you can take money out of it for any medical expenses, and all the earnings going to be free. You don't have to spend all the money from HSA account. It's also tax deductible. Great way for you to create another bucket that you can tap into tax-free for any medical expenses, which you probably will have in retirement. So that's a tax saving strategy, and also saving for medical care. Maybe you can decide to work a little bit part-time, maybe some little side job. If you're self-employed, you have an opportunity for a couple of years to work and have a lot of write-offs. Maybe if you're working in your office, home office expenses, your utility expenses in the home office, your equipment. So even you might be making as a contractor 20,000 a year, but after all the write-offs, your taxable income could be 5,000, and you put that 5,000 in traditional IRA, you have zero tax on your self-employment income, which is fantastic. Adjust your expectations, lifestyle, relocate, and retirement. I'm not a big fan of adjusting your expenses. What I like to do is I like to match your expenses with your income to see is there any deficiency. If deficiency big enough exists, we can reconsider relocating, selling, renting, moving. But in general, people really want to stay where they are. Maybe kids are around, so we try not to distress the retiree by moving. We want them to be where they're most comfortable. Some retirees love to move to different states where there's low income tax, like Washington State or Florida, but it's going to be a very personal choice. Our goal is to have least destruction to what you've been accustomed to and help you to maintain a lifestyle in retirement that you desire. Another way of thinking about your expenses is keeping more what you make. Example would be if you are accumulating money in non-qualified assets, how much capital gains are you paying each year? How much tax-free income versus taxable? How much qualified dividends? Because all of these income levels I mentioned, they're taxed on a different level. Capital gains, long-term and qualified dividends are taxed at the long-term capital gain rate, where ordinary income tax rate applies to your ordinary dividends and also interest income. A lot of people are very excited. They say, well, the savings account, money market pays right now 4.5%, 4%. Keep money in cash. This is great. It's great till you know what's the inflation rate. It's great till you know how much tax you pay on that interest. Example, if you are in a 25% tax bracket, you're making 5% interest in money market, which right now actually pays only 4%. So how much is going to IRS before you net it? Well, 25% at least, right? So if it's 30%, 1/3 of what you earn, so if you're earning on $100,000, 5% of 5,000, 1/3 of it will go, $1,500, will go to paying federal and state tax. Your net to your pocket is only 3.5%, $3,500. So you need to calculate how much you're keeping. What's the most efficient way for you to earn income? Especially it's important for those who are on Medicare, because once your Medicare income, including your tax-free income, taxable income, dividends, IRA distribution, Social Security, if it goes over a certain threshold, guess what? Your Medicare premiums increase. So tax planning around your distributions is very important to keep you under certain thresholds. Covered California, for those people who are not working or working for themselves, or early retirees, you qualify for Covered California subsidy, great. But what income level do you need to be? How do you structure your distributions? You can have $1 million in your bank account, still qualify for Covered California. Why? Because your income level is low. So this type of planning is very important because it's not what you make, it's what you keep. Sequence of return risk. I don't know if you've heard of that, but this basically says, if we look at first scenario, year one, you've just retired and you're making 12% return, 24% return, year 3, 14. So let's say you retired at the end of 2022, perfect timing. And then you had a fantastic 2 years in the market. Guess what? You will have a higher chance to make much more money as you go through retirement. Why? Because whatever you're taking as a distribution, as long as it's between 4 and 6%, it's much less than what you're making. But now let's reverse it. The person who has been making a lot of money in the beginning, toward the end of life, year 28, 29, 30, the market declined. So it's not detrimental to their asset. But if those 3 declining years, which is rare, we usually see 1 or 2, usually 1, but let's say we have 3 bad years, person retired at the beginning of 2007, worst time in decades. And then their portfolio distribution were not keeping up with the growth of the portfolio. So you can see that portfolio declined pretty quick within first 5 years. And because of that, it's very difficult to recover and recoup. So how do we control that? How do we control our way of taking money? Simply by having enough money in bonds, so you don't touch stocks when they're down, and also by having reserves. So something called bucket strategy. The bucket strategy is a simple strategy where you say, how much do I keep in each bucket? In my emergency funds bucket, you always should have it, and it should be a much larger amount a year before you retire. The second bucket is an income bucket. How much is income bucket I need for distributions? Usually it sits in a non-qualified accounts, you're earning interest, dividends, and you're not taking too much risk. And the last bucket would be your longevity bucket that will keep you going for the next 30 years in retirement. That's your IRA Roth money, should be more focused on growth. On top of it, we're always looking at withdrawal baseline rules. What those rules says that as long as you're staying within 4 and 6% distribution rate, and as long as you're making at least 5% rate of return, you should be okay with very high chance not running out of money. If your portfolio making more than 5%, 6, 7 plus, in a particular year, you can give yourself a credit. You can give yourself a little bit more money end of the year, put it in savings, replenish your savings. If the market declines, you need to give yourself no more than 4% or even less. So if you have that flexibility to adjust based on market returns and inflation, your chances of you running out of money decreases. So we have this safe channel of distribution that based on inflation, market return, and how many years till your life expectancy. So that creates a very high chance of not running out of money. Now, this is very interesting statistic showing you that depending how you invest the money, this is how much maximum initial withdrawal rate you can assume and give yourself as the additional distributions from the portfolio. With the 99% confidence standard, meaning 99% chance you will not run out of money, if you're in the portfolio column number 2, 50% stocks, 50% bonds, right? So 50 stocks, 50 something conservative, we call them bonds, which don't fluctuate, don't make a lot of money, don't go down as much. You can distribute yourself 4.6% rate, and you have a 99% chance you will not run out of money. Please examine that if you have a little bit more in equities, which means stocks, 65%, your distribution rate increases. However, the higher your return, the higher allocation to stocks, at some point it becomes not productive. Like if you look at 80% stocks and 20% bonds, you actually increase your risk level by quite a bit from 65 to 35, but your distribution rate didn't go up as much. So at some point, you really don't need to take excessive risk to continue a reasonable distribution. So, however, if you are all in safe haven and you're only 100% on bonds or bonds and cash, that your distribution rate drops because your rate of return goes down. So you need to find a happy medium at what portfolio level you can produce enough return in order to give yourself distribution rate of the one that you require. But that's your general rule of thumb. If you're very conservative, that probably 4% is your distribution rate that is safe. And if you have 80% in stocks, that you probably can give yourself 5.5% distribution rate. Next step, utilizing retirement worksheet that we can provide to analyze your expenses, your income, and come up with your own solutions and recommendations. Sometimes it's very easy for you if you have already been organized and you already did some homework to figure out your initial distribution rate and your safety rules. But if that's not possible, you can seek help of a professional as a planners. Financial Planning Association have a planner search tab where you can search planner by your zip code and find someone who can help you. And it's a great organization because it provides a lot of financial education and literacy to surrounding community just to help strengthen the fabric of our communities and their financial well-being. So with all of that, we finish our presentation. We are at 7:37, and I would like to see if we have any questions. I will be very happy to answer.
Hello, everyone. If you have any questions, I will read them off and then the presenter will answer them. So everybody gets the answer.
Thank you. So I had one question that was posted to me prior to this presentation, hoping that this question will be addressed during the presentation. So I will read it, and maybe it will be good for a lot of people to know. How do financial planners lower the income for their clients to qualify for Medi-Cal? So this question is not specific, because Medi-Cal is the lowest medical coverage people have when they don't have any income, pretty much very low, and less than $2,000 in assets. So if you want to be on Medi-Cal, you should have no more than $2,000 in bank accounts and in savings, and your income should be very low as well. So qualifying for Medi-Cal specific coverage is very difficult for anybody who has any assets. If you're talking about long-term care that's covered by Medi-Cal, that's a different story, because you can go to a long-term care facility if you're Medi-Cal eligible patient, and you can own a home, but you don't have a lot of assets. And if that's the case, the state will cover all of your long-term care expenses, but they might go after your property after you're gone, because you will sign a waiver. So it depends what you're asking. As far as the premium for paying, well, Medi-Cal is a zero, that you don't pay any premiums for Medi-Cal, right? So you're probably asking about how do you qualify. There is a 2-year look-back rule. For instance, you give away all of your assets so you can qualify for long-term care. If it happens within 2 or 3 years, then state of California will consider those assets yours, and you will not qualify. So you need to gift a lot of things. Not a good strategy, because the long-term care facilities, Medi-Cal-based, are not maybe don't have as many choices if you're regular private stay, and also probably the care is not best because of that. So I hope I answered that question. Okay, so thank you for the questions. I'm going to read them, and we'll go one by one. Can you go over the part about inheritance and withdrawal at the 10-year? Yes, because it's a new strategy, there is usually a lot of questions around it. So if person inherits an IRA, let's give an example, and let's say the parent already been taking required minimum distributions, right? So the parent was over age of 73, taking required minimum distribution. You, as the beneficiary, by new IRS ruling, must start taking your RMDs and deplete the IRA account by year 10. So you need to start taking year 2025. The previous, even though the law was enacted a couple years back, they were not clear on if you should take it or not, if the deceased person had an RMD requirements. Now they said we will not penalize anybody who hasn't taken it, but starting 2025, you must take it. So that's very important. That's something new this year. If your deceased family member was not required to take RMDs, then you can wait, and you can take IRA distributions any year, but you need to deplete the account by year 10. So if your family member passed away in 2025, by 2026, 35, you need to deplete that IRA account. You can choose when to take it, maybe when you retire yourself, your income drops, maybe you're between jobs, or maybe you just gradually take it over 10 years bit by bit. But the strategy needs to be created. Roth accounts does not have income limitations, so you can take it anytime you want. This is just, the previous conversation was about IRA accounts and 401ks. In the slide showing different safe withdrawal rate, assuming different equity bond allocations, what is the time period being assumed? So let's go back. Oops, excuse me, I just closed the chat box. So let me reopen it. I will try to go back to our slides. So there is no time, so the time here is the lifetime. So basically it says here that if you take, if I understood your question correctly, if you're taking distributions for during your retirement, the chances of you running out of money is 0. Assumption most likely is that you're starting in your 60s and you go all the way to your life expectancy, let's say 95. But it basically says that there are always going to be a balance left. You will not run out of money. The chances of success that you will have some money left, whether a lot or not, depends on your performance of your portfolio. But if you are 50-50 stocks, 50 equities in general, and you're taking 4% distribution of 4.6, you will not run out of money. 99% success rate. Now, let's put a little caveat to it. If you are 50% of your equity in Tesla stocks and 50% of your equity in a treasury bond, and that's all you have, that's not diversified portfolio. So this rule would not apply. But if you have a fully diversified portfolio with several stocks, 500 stocks, and also a lot of different bonds, not junk bonds also, right? Junk bonds are very high yield, but also higher risk. So you have a very nice diversified professional portfolio between stocks and bonds. Your chances, you will not run out of money if you're taking 4.6% distribution rate per year. So thank you for those who joined and who had to go. Can you go over the Roth IRA parts, taxes and inheritance for your children? So the Roth accounts are not taxable to you and neither to your children. Previously, you can stretch your Roth IRA distribution. You don't have to take the money immediately, but the rules have changed. You have to deplete your Roth account by year 10. When you take the money out will be up to you, but they need to be depleted. There is no tax ramifications, neither for you when you take the money out, nor for your children or those who inherit the Roth account. If I didn't answer this question fully, please let me know. Look back rule was 5 years. If you're talking about medical, it could be. I'm not specialized in medical. It used to be 2 years, but you might be right. They might have increased it because I believe I've seen it. It's longer than 2. I don't remember if it's 3 or 5. To be on the safe side, it's considered 5. And I would not, by the way, Medicare planning is not considered legal. So because if you want to be in poverty by design, that's not what Medi-Cal is for. Medi-Cal is to protect those people who are not fortunate enough to save for the health care, so they're not on the street. Is the 10-year withdrawal requirement discussed also for 457, mentioned 401k, but unsure? Yes, correct. Great question. So all the pre-tax money, whether it's 457, 403b, 401k, or qualified deferred compensation plans, all of this follow the same rules, same 10-year rule as I discussed. And remember, inside of that 10-year rule, you have required distribution if your deceased family member already was required to take RMDs. And if he or she were not, then you don't have that requirements. But all of beneficiaries have to take money out completely by year 10. So great question. Correct. Thank you for asking that. What changes should I make in my safe withdrawal rate if retiring in my 40s or even 30s? Great question. So It's actually interesting enough, but the distribution rate does not change. I'll explain to you why. So let's say I'm in my 30s and I have $1 million. And I know that I'm young and I would create a portfolio of 80% stocks, 20% bonds. And I can take 5.6% from my account for the rest of my life. If I am in my 50s or 60s and my portfolio is 65% stocks, 35% bonds, I'm only taking 5.3. So it's really don't depend on age. It depends how you invested. This graph describes that what the distribution rate can take my account in perpetuity means if I give you an example, 80-20 portfolio generally generates on average annual return. Average is the keyword, about 7.5%, 8% before fees. So if I am taking 5.6, right, paying taxes on that money, everything else. So I'm taking 5.6 on $1 million, I take 56,000. I still have remaining additional 1.4% of the portfolio, which is $14,000 to reinvest my dividends, to reinvest my earnings. If I'm making 7% net return after fees, right? So you're always reinvesting because you're reinvesting, guess what's happening? Your $1 million is creeping up bit by bit by bit by bit by bit. So the chance of you to running out of money is very, very low. If my portfolio is making 5% return and I am in a 50-50 allocation and my portfolio makes 5.5% return, I'm taking my 4.6, I'm leaving 1% in the portfolio. Same thing, I am reinvesting some earnings. Where the problem arises when your portfolio average return, which you should examine what's your average return on your portfolio in the last 5-10 years, 3 years, 5-year, 10-year, you need to know. Then if I'm taking 5% or 6% and my portfolio is making only 4%, then eventually your portfolio value will go down, especially with inflation. So idea is to take less what you earn on a long-term basis. If on a long-term basis, your portfolio can generate, and this is based on an indexing, basically means if I put it S&P 500, I put it in BND bond index, what chances for me to not run out of money and how much I can take. So you need always to make as much as you make or a little bit more. And we probably will have 2 more questions. By any chance for medical, how do and what are effective ways that financial planning and estate planning law offices do in order to lower the income for their clients to qualify for Medi-Cal? So if you're talking about Medicaid, it's called Medi-Cal in California. I already mentioned there's your income has to be very, very low. I don't do medical planning because most of my clients have over $1 million of assets, so it doesn't apply to my practice. And some estate attorney might do it. In order for you to qualify for medical, the only way to do it is for you to gift your assets away and leave very, very little to yourself. You can leave the house to yourself, but all other assets have to go. And if your income from pension benefit and Social Security is still high, you probably will not qualify for medical. So you need to talk to a state attorney and CPA to find out, but generally it's very difficult to do. If you're talking about Medi-Cal, right? So Medicaid, called Medi-Cal in California, it basically means that you're paying no premiums for your insurance because Medi-Cal covers everything, but you should not have more than $3,000 a month worth of income for couple, and the asset level is very, very low as well. So